Welcome to the deep dive. Today, our mission is really to analyze the global economy, and our sources are describing it as standing at, well, one of the most uncertain junctures in modern history. We've pulled together some, frankly, challenging data focusing on three crises that seem to be converging and reshaping the global landscape right now. We're looking at, first, the unprecedented weight of rising global debt. Second, the speculative, almost euphoric potential AI bubble. And third, the deepening U.S.-China tariff war. It feels like a struggle, where technological optimism, economic ambition, and this geopolitical rivalry are starting to work against each other. So what happens when these three massive forces collide? Let's try to unpack this.
Yeah, I guess like, and these three issues, they aren't really isolated events, are they? They form this fragile kind of interwoven system. So a shock in one area, say a big correction in tech stocks, or a major government default, maybe a new round of trade barriers, it gets immediately amplified. Amplified because of the structural vulnerability in the other two areas. We're looking at an economy that's running on huge amounts of credit, but also simultaneously it's being overheated by, well, pure speculation.
Okay, let's anchor this with some hard figures. The debt one is quite something. Global debt. The aggregate number has now surpassed $315 trillion. I mean, that's more than three times the world's GDP. It seems pretty clear that the financial system is overwhelmingly running on borrowed money.
It is. And what's really significant here isn't just the total sum, massive as it is, it's the concentration of that debt,
Hmm.
particularly in advanced economies, the U.S., Japan, the EU. Take the U.S. national debt alone. It's over $35 trillion now. And the costs just to service that debt are immense.
Could you just clarify for the listener, what does servicing that debt actually mean in practical terms?
Absolutely. Good question. When we talk about servicing the debt, we mean the payments required just to cover the interest, not even paying down the principal amount borrowed,
Yeah.
just the interest. These are mandatory payments, right? And they put a massive strain on federal budgets. In the U.S., like I said, these interest payments now actually exceed military spending. Think about the implication there, the opportunity cost. That money isn't available for other critical spending, things like infrastructure or investing in clean energy or social safety nets. It forces really deep, difficult trade-offs in national policy.
Right. And even though the bulk of this debt is held by richer nations, the strain often feels heaviest for the developing world, doesn't it? You get this rising dollar strength. It makes their imports way more expensive. Investor confidence tanks. It seems like a vicious cycle.
That's exactly where the currency risk becomes almost paralyzing for some countries. Countries like, say, Argentina, Egypt, Pakistan, they're facing huge external debt burdens. That means the debt they owe in foreign currencies, usually U.S. dollars. So when the dollar gets strong, like it has been, that debt just becomes cripplingly expensive to repay.
Hmm.
And that pushes their governments towards really painful austerity measures.
Which means cutting public services.
Exactly. Severe cuts to public spending, services,
Yeah.
things people rely on. And inevitably, that fuels political instability. We see that pattern again and again.
And China isn't immune either, right? Their debt situation looks different, but still worrying.
Oh, definitely. While their national debt profile is different, a lot of their risk is concentrated internally, specifically in two really precarious areas. The highly leveraged real estate sector, which we've heard a lot about, and also these local government financing vehicles. This whole situation significantly threatens the foundational stability of their growth model, the model they've relied on for decades. So if you connect all these debt points together, look at the bigger picture. The prognosis is quite sobering. You have high debt combined with, frankly, slow structural growth, especially in mature economies. It really suggests the global system could be facing a period of, well, prolonged stagnation. This financial weight just drags everything down.
Okay, so that slow growth defined by the debt crisis probably encourages investors to chase the only thing that looks like high growth, right? Which brings us neatly to that parallel crisis, the speculative euphoria building around AI. So now we're shifting focus a bit from credit risk to speculative risk, this potential AI bubble. I mean, the investment in AI, driven by giants like NVIDIA, Microsoft, OpenAI, it's created trillions in market value. But it feels like it's based almost entirely on the promise of automation and generative intelligence. Is that promise actually being monetized yet?
That is the absolute critical question here. There's extraordinary optimism from investors, no doubt, but the underlying commercial viability, it's still pretty uncertain for many. The cost just to train and run these huge AI models remains extraordinarily high. It's a massive upfront capital expenditure capex that somehow needs to transition into scalable, profitable business models. And that transition isn't straightforward. Analysts are, increasingly drawing parallels to the late 1990s dot-com bubble. And you can see why. It's a similar fundamental pattern, isn't it? You have many AI startups with multi-billion-dollar valuations, but little to no actual revenue coming in the door. Despite those record valuations, the majority of AI firms right now are just not profitable. The core economic challenge turning immense computing power into reliable revenue streams that still seems quite elusive for many.
And the infrastructure demands alone are proving incredibly costly. We're talking about energy consumption, data processing needs. They seem to be rising exponentially, far outpacing actual revenue gains in many cases. I saw one example. OpenAI reportedly spends hundreds of millions of dollars monthly just on computing power. That's a staggering operating cost before you even think about salaries or sales teams.
Correct. It's huge. So if those hoped-for massive productivity gains don't materialize quickly enough, or maybe if competitors jump in and erode the margins too fast, well, that AI-driven market looks pretty set up for potentially a sharp correction. And this wouldn't just hit venture capital, would it? It could destabilize the broader tech ecosystem. And that ecosystem has been the primary driver of global market growth for, what, the last decade?
Okay, so if debt is the anchor dragging down growth and AI speculation is maybe the balloon threatening to pop, what's creating the instability and friction between them? That seems to be the third crisis. The intensifying tariff war between the US and China. I mean, together, these two economies account for nearly 40% of global GDP. And their rivalry has clearly escalated, right? From a trade spat in 2018 to a full-blown technological and economic contest now. The US has significantly expanded tariffs, hasn't it? Specifically targeting key sectors for the 21st century. Things like semiconductors, electric vehicles, other green technologies.
Yes, very strategic sectors. And China, predictably, has responded strategically too. They've implemented countermeasures, things like restrictions on the export of rare earth minerals. And rare earths are absolutely critical components for everything from consumer electronics to advanced defense manufacturing. So hitting rare earths is a strategic choke point. It's aimed squarely at disrupting high-value U.S. supply chains.
And the practical consequence for big multinational corporations is that they're being forced to de-risk, as they call it, moving significant parts of their production out of China, relocating to places like Vietnam, India, Mexico. Now, while that diversifies global supply chains, which might be good in the long run, it must come with a pretty steep price tag in the short term.
Absolutely. And this is where you find some really damaging inefficiency creeping into the system. Corporations often have to set up expensive dual supply chains or duplicate manufacturing facilities. They're losing that highly optimized, incredibly efficient, low-cost labor and logistics ecosystem that China perfected over, 30 years. And the result? Rising operational complexity, higher costs.
Yeah.
And that inevitably contributes to global inflation. It feeds back into the system.
And this conflict isn't just hurting the U.S. and China directly, is it? The tariffs slow exports, they weaken consumer confidence inside China, which must be worsening their domestic crises, like in property and youth employment. And meanwhile, other economies across Europe, Asia, places that depend on open trade and global demand, they suffer too. Reduced exports for them, volatile commodity prices, it ripples outwards.
It does. It creates this broader global slowdown effect.
Okay, let's try to connect these dots now. How do these three problems, debt, AI hype, trade wars, how do they start interacting? Because the sources we looked at are pretty adamant that they're feeding into one another in a dangerous kind of feedback loop.
Absolutely. Let's synthesize this. Think about it this way. First, the high global debt limits the ability of governments to step in. They don't have the fiscal firepower to cushion against market shocks like they might have done in the past. Their hands are tied.
Yeah.
Second, the AI bubble. It creates massive asset price inflation, yes, but also financial distortions. And frankly, some of those distortions look distressingly similar to the conditions we saw before the 2008 crisis. Huge valuations chasing future promises. And then third, the tariff war. All that trade friction, the supply chain inefficiency we talked about, it drives cost-push inflation across the globe. It makes things more expensive. And that forces central banks to maintain tight monetary policy.
Meaning high interest rates.
Exactly. They have to keep interest rates high to fight inflation, which in turn raises the cost of borrowing globally. And that directly exacerbates that $315 trillion global debt crisis we started with. You see the loop.
Wow. Yeah.
The crises amplify each other. It's a reinforcing cycle.
And this instability, it's also accelerating geopolitical shifts, challenging established norms, isn't it? We're seeing this maybe quiet, but definite resistance to the dominance of the U.S. dollar. Countries are actively looking to settle trade deals in their own local currencies more often. That shift away from the dollar, it seems like a trend that's being accelerated by this very fragmentation we see between Washington and Beijing.
That's a really important point. And bringing this back down to the individual level,
Mm.
how are these huge tectonic shifts actually playing out in people's daily lives? The human and political dimension here is critical. We are seeing social inequality widening sharply, and it seems driven by these very structural forces we've just discussed. Think about it. The tight monetary policy, driven partly by the tariff war, makes debt, mortgages, housing less affordable for the middle class. But at the same time, the speculative AI bubble drives up the value of tech stocks and other speculative assets, often held by the wealthy. So you get this widening wealth gap that's directly attributable, at least in part, to these macro crises working together.
And the promised benefits of AI, they might not be universally distributed either. It's often touted as this great tool for progress, but it also risks deepening inequality, right? By potentially displacing millions of workers in areas like logistics, customer service, even content creation. That puts further pressure on incomes for many people.
Precisely. And add to that the debt-driven austerity measures we mentioned earlier, especially in the developing world. Those are already fueling significant political unrest.
Hmm.
You see it from Latin America to South Asia, and even within advanced democracies, this kind of economic polarization, this feeling of being left behind, it's clearly driving populist movements that challenge core institutional stability, so the global economy's fragility.
Hmm.
It's not just financial anymore, is it? It feels deeply social and institutional, too.
So the core conclusion seems pretty stark then. The same forces that really drove decades of globalization and innovation, things like credit expansion, technology, interconnected trade, they now seem to be turning against one another, creating a genuinely precarious global future.
That is the crucial distinction, I think. Unlike the 2008 crash, which, while devastating, was largely contained within the banking and financial system initially, today's vulnerabilities feel much more structural. They seem embedded in basically every pillar of the global economy, governments, corporations, and ordinary consumers. It feels like the entire world is shifting structurally, moving from a period of integration towards one of, well, division and fragmentation. And maybe here's a final thought, something for you to mull over as these crises continue to unfold. If this AI revolution becomes captive to speculative finance, reliant on unsustainable credit, is it actually doomed to accelerate these global contradictions? Could it end up deepening inequalities and market volatility rather than providing the solutions and the productivity gains the world so desperately needs right now? That, I think, is the really big question hanging over us.